Good afternoon, Joe Victor with Allendale and Corporate, the closing commentary for Thursday, June 3rd, and of course, soybeans. Soybeans and the soybean meal catches fire. Higher markets ran right smack dab into resistance, whether you're looking at old crop or even new crop. New crop resistance I have right now at 921 3/4. Support coming in at 893. That's new crop soybeans. Why? Why do we see meal in the soybeans higher? And that's primarily have a large international commercial that is stopping receipts. Used to make, good laughs about years and years ago about how there was a different commercial that is no longer in business, did a majority of their merchandising through stoppage of receipts. Well, now we have an international marketer that is out there stopping soybean meal receipts and buying those receipts, and what that tells us is the merchandising SIF rate is higher. Not only do we see a SIF rate that is higher, Gulf, insurance, costs, and freight, we see a SIF market that's higher. 65 bid versus 68 offered is the nearby. And of course, July, not that much difference. And what it's doing is the Gulf market is competing with the domestic crusher market. And speaking of which, Allendale did release the estimates for the upcoming, that's next Thursday, the 10th of July, and of course, or 10th of June, and that is going to be the World Ag Supply Demand estimates. And what we're saying at this point in time is quit messing around with the residual. We understand that when you have high crops, corn and soybean production in 2009, we don't need to see any kind of adjustments being made in accounting errors and residual. Now, what we see is mainly a market that needs to see ending stocks lower for corn, primarily because of exports and ethanol production. We need to see a lower soybean meal end stocks on old crop. That's primarily because of crush as well as exports. So USDA, get it through your heads that we don't need to be messing around with the residuals as much as we do getting to the true matter of the point, and that is, again, fact is, you see lower ending stocks on old crop corn and soybeans. Along with it, China, there's a rumor out there right now that China may be interested in U.S. soybean oil and going through phytosanitary issues at this point in time, and may be willing to go ahead and take U.S. soybean oil over Argentina. Argentina still doesn't get it, and that is they have to import from China, and primarily it's steel pipe, shoes, as well as toys. And we'd like to see some imports, keep those workers happy within China. If Argentina is not going to do it, then we see that the exports of soybean oil to China, for the U.S. to China, being more of a, at this point in time, more of reality than perception. Along with it, we have a wheat harvest that has started. Reports coming in, primarily Texas, the Texas Panhandle, North Central, Oklahoma, and just now, very early cutting going on in Kansas, and that is higher yield, higher test weights. But again, you'll take a look at what we see as lower production, hard red, higher soft red wheat production than what USDA has. At this point in time, you're looking at support in the December corn, 365. Allendale suggests a high tolerance of resistance coming in at 393 and a half, and we're saying again, you get in that $394 region on new crop, you better have box option strategies put in place. And of course, you can read about special reports that we put out about the getting long into this market before it breaks. And of course, at the same time, we also put out a special report yesterday primarily about crop conditions. Everybody's abuzz about the crop conditions for corn coming in at 76%, good to excellent. What does that really mean when it comes to yield when we get into harvest? As more importantly, take a look at what happens to price, and you'll find that in our special report section. Along with that, Asia, we believe that Asian demand is picking up. You can talk about Europe all you want, about Greece, Italy, Spain, but at the same time looking at real demand, and that is that Asia is picking up. International fleet up 40% versus year-ago levels. And why is that new fleet coming on? And that is, again, back in 2008 when South Korea canceled 8 ships at $1 million a crack, you're finally starting to see those ships that are coming onto the marketplace, and it is primarily Panamax-sized vessels. Along with it, we're going to have exports tomorrow morning. figure, at least again, solid exports have to have them because of the price break, primarily in the starches, have to have the world marketplace coming to the U.S., and that is for U.S. starches, primarily corn and wheat, and of course it'd be nice to see some solid export numbers in the soybeans. Along with it, looking for outside markets, you still have to give respect where respect is due, and that is in the crude oil. And if crude oil is going to continue to be more sideways, stock market sideways, and the dollar sideways, what's that do? Weather's a key driver, and that is something that you have to pay attention to. And at least 2 private weather forecasters saying right now for the next 2 weeks, no problems whatsoever as far as the weather is concerned in getting this corn and soybeans off on the right foot. Any questions or comments that you have, feel free to give us a call, 800-2-MARKET. That's 1-800-262-7538. This is Joe Victor with Allendale Incorporated for Thursday, June 3rd. Thank you. We'll be back with you tomorrow morning.